Ever wonder how some people pay $0 tax on their incentive stock options while you're slammed with a massive tax bill? As an equity advisor to wealthy tech execs, I've seen ISO taxes quietly become people's biggest lifetime expense. So in this video, I'm going to show you the step-by-step strategy you can use to pay $0 on $100,000 worth of incentive stock options, even if you've never handled equity before, or you're in a high tax bracket. To start, let me show you how to pay $0 in the AMT so you can spend that money on what matters most to you, like traveling. This cup is your $0 AMT bill. Every time that you exercise or buy your ISOs, you pour a little water into the cup. If the water stays in the cup, you owe $0 in AMT. If you pour in too much water and the cup overflows, any water that spills out of the cup becomes your AMT bill. The goal is to not let this cup overflow so you can avoid AMT and put that money towards your dream vacation. So how do you make sure that your cup never overflows? Let me break it down step by step. Step 1. Understand how much water you're working with. This water is called bargain element. It's just the difference between what your shares are worth right now, the fair market value or FMV, and how much they cost to buy, also known as the exercise price. To find your total water / bargain element, you'll want to take the spread and multiply it by the number of shares. In this example, $15 fair market value minus $3 exercise price times 10,000 shares equals $120,000 worth of bargain element or water. You can see if you're likely to trigger AMT by using my spreadsheet with the exact numbers in the description. Step 2. Find out how big your AMT cup is. This is your AMT threshold. It's the amount of water your cup can hold before the cup overflows, or how much bargain element you can have before you trigger AMT. If you're single earning $100,000 per year, your cup can hold about $38,000 worth of water before it spills and becomes AMT. Here's an unsolicited AMT joke. Does the tax planner consider this glass half full or half empty? He considers it a empty glass. Get it? AMT. Okay, I shouldn't have written that one. That was bad. But even if you're under that threshold, there's still a few things that could cause you to wreck your tax bill and gush water outside of the cup. So next, I'll show you how to stay as dry as the Sahara Desert. No surprise AMT bills. Imagine trying to walk around with a cup all day that was filled right to the brim without spilling a single drop. It's nearly impossible, right? So how do you avoid spilling water once your AMT cup is full? Let me show you how to keep your cup as tight as a ship. Here's the tricky part. Even if you fill your cup perfectly, other income can sneak in, causing it to spill and trigger AMT. Think bonuses, think restricted stock units, Roth conversions, which is simply moving money from a traditional to a Roth account, and other surprise tax events. If you fill your cup to the top on January 1st, you'll have to keep the cup steady all tax year long. And that's tough because there always seems to be something unexpected. One strategy to consider is exercising your options toward the end of the tax year when your total income is clearer and you know how much water is already in your cup. That way you don't have to worry about it spilling for 365 days. You have a much better idea of how big the cup is and how much water you're dealing with. To the contrary, if you think your company's stock price will jump during the year and you want your bargain element or water to be as small as possible, you might want to exercise earlier in the year before the bargain element or water increases. It's a bit of a trade-off that you'll have to weigh. The truth is, it's very difficult to predict your exact income down to the penny. There are always a few $100s here and a couple thousand there in surprise income or other tax variables. If your AMT risk is high, work with a specialized equity professional. It's not worth risking a huge financial mess because you want to try and figure it out yourself with an AI chatbot. But what if your AMT bill is huge and you've got way too much water to fit in the cup? If you're worried about your water overflowing and triggering an AMT bill, there are a few levers you can pull. First, you can get a bigger cup. And second, you can pour in less water. But how do you actually do that? Let me show you so you can create the biggest possible gap for a $0 AMT tax bill. In some cases, you could literally pour in air into the cup. No water, no AMT to worry about. To start, I'll show you how to get a bigger cup. You can increase your AMT threshold by having more regular income. This can be done by exercising or buying non-qualified stock options, doing Roth conversions, or selling some stock held less than a year, just to name a few. please check with the tax pro for the details that fit your specific situation. Now let me show you your second lever, which is pouring in less water. If you have multiple batches or tranches of options granted at different times, look for the ones where the fair market value or current stock price is closest to your exercise price, the price that you paid to buy them. If you want to minimize or avoid taxes, start with the shares that have the lowest amount of water per share. That way you can exercise more shares without overflowing your cup. You might even have some where the purchase price and the fair market value are the same. Exercising those shares is like pouring air into your cup. There's no bargain element, no AMT to worry about. But here's the catch. Exercising more shares can cost you more money up front and mean more risk. So always weigh the risks and reward before acting. But everything we've talked about so far only gives you a $0 tax bill at exercise when you're purchasing the shares. What if you want to sell your ISOs and avoid taxes then? Up until now, we've been focusing on not spilling any of the water while filling up our AMT cup. Now we have to worry about tax when we get the water out of the cup. You could continue to hold the cup and not drink it. You can drink so little that no one notices, or you can actually pass the cup to someone else. But how do you actually do that? Let me show you the exact 7 ways to pay $0 in taxes on the back end. The first few ways involve passing the cup. Think about someone who's in a lower tax bracket than you. Maybe it's a relative or a friend. Rather than selling and recognizing the tax, you could gift that stock to someone else. That means a couple of things. You're avoiding tax, someone else is paying it, and when it is taxed, it's at a lower tax rate than yours. You can gift thousands of dollars away for free each year without triggering gift tax. Who knows, you might even make some new friends by gifting some money. The second way to pass your cup is by examining your shares. Look at the holding period to find the ones that have been held for longer than 1 year, or exercised at least 1 year ago. If it's been at least a year since purchase or exercise, you can donate them to a charitable organization, which provides 3 benefits. You avoid paying tax, you do something noble and support a cause you care about, and you can possibly get a charitable deduction to reduce your regular tax bill. Now let me show you how to continually hold the cup. The first way to metaphorically hold the cup isn't the easiest, but you're going to have to die. When you die holding an asset, your heirs don't have to pay taxes on that asset when they inherit it. This is known as a step up in basis. There are tons of benefits to this. You don't pay tax, your heirs don't pay tax, they get a step up in basis, and the IRS doesn't get any money as long as your estate isn't absolutely massive. But up until this point, you've never actually been able to drink from the cup. So let me show you how to actually drink from the cup. Start by examining your shares. Look for any shares that were purchased or exercised at a price higher or equal to the fair market value. When there's no gain or you sell for a loss, you get 3 things. No taxes due, liquidity, and if you have losses, you could write those losses off to offset gains and reduce your overall tax bill. I've worked with many Tesla employees who've had massive gains and massive losses cooked into their equity due to the volatility of Tesla stock. You might be thinking, of course selling at a loss means no taxes. This is a given, Riley. Well, what if I told you that these next several options allow you to sell for a gain and still not pay tax? Number 6 is like drinking so little water from the cup that nobody notices. But you could also drink enough to quench your thirst on $100,000 worth of gains or water. This is how you can avoid taxes even when you do have gains. You could save up to $13,500 in taxes. Of course, results will vary for you and my clients. Let me show you how this works. First, before you earn any income for the tax year, your tax liability is $0. It's actually a negative number thanks to the standard deduction. So technically the first $30,000 is earned income tax-free. That tax-free amount could be larger if you have losses to write off. Second, did you know there's an actual 0% tax bracket in the tax code? Well, it exists only in the long-term capital gains tax bracket. But here's the catch. There's only $100,000 of it, and it sits on top of your ordinary income. So if you earned $90,000 of salary, that would mean that you only have $10,000 worth of 0% capital gains tax rate left. But how do my clients take advantage of the $0 tax bracket when they're earning millions of dollars per year? Well, they're strategic about timing things. Sometimes they take a year off or write off losses to eliminate or reduce their income. Depending on your unique circumstances, this tax strategy might not enable you to save up to $13,500. This is why it's critical to work with a professional. This next option literally doesn't require any work or strategy on your part. You simply sell your incentive stock options and you don't pay the IRS. Okay, that was a joke. It's illegal and you will go to jail. Do not do that. It's called tax evasion. The CFP board is going to revoke my license after that joke. But for real, this last one, the IRS literally says don't pay us, even if you make millions and millions of dollars. In all of the tax code, I physically don't know of a single better cheat code than this one right here. If you join a startup while the gross assets of the company are less than $75 million, then you can exclude up to $15 million worth of gains from taxation. That's millions of dollars tax-free from a federal standpoint. And some states even honor that from a state income tax perspective. But the reality is a $0 tax bill could actually be one of the most expensive decisions you ever make. I'm going to show you how to actually cut your net tax rate by paying AMT in this video. Click here to see how it's done.